Hey everybody, and welcome to the PlantStock channel. My name is Jesse if we haven't met yet. Today I have two news items. I'm going to talk about the Very Good Food Company that they actually now acquired their $70 million loan, and I'm going to move on to talk about TTCF, the chef, regarding how well they did in the month of May. But before we get to it, as always, I would truly appreciate an early thumbs up since it does really help spread the videos to more people out there. And if you haven't subscribed to the channel yet and you want to get more news and analysis regarding plant-based companies like the Very Good Food Company, like the Tattooed Chef, Beyond Meat, and more, make sure to subscribe and don't forget that bell button. Thank you folks, I truly appreciate your help. Now if we take a look at the stock chart, ticker symbol VRYYF, in the Canadian TSXV, we can see this is actually pre-market. It's like 4 or 5 minutes before it opens up. And on Friday, it landed at 4.5 Canadian dollars. And as we know, the last couple of days has been kind of a straight line here since Tuesday last week. But so nothing much is happening. We'll see what happens with this latest development. And let's also take a look at the American ticker symbol VRYYF, which is the OTC market in American dollars. The last 5 days, you can see basically the same development here as they are interconnected. It landed on $3.77. Now, first of all, when I saw the news today regarding that they had closed the $70 million loan, I got really nervous because I remember a couple of months ago, there was news about that too, right? I covered it. I talked about a $70 million loan and I was like, whoa, are they actually going to borrow another $70 million? But then I realized that it wasn't closed. It wasn't a signed deal, the one here 3 months ago. So that's the difference. Whew! But at the time, we didn't know the investment firm, and now we do. It's with VRYYF Capital and 9 Point Partners, right? So basically what they're going to use this money for, we've talked about it before a little, but they go in a little more specifically here now. And first of all, it's going to be about 20 million revolving line of credit and then 50 million senior secured asset-backed term loan. Interest payments only on drawdowns and repayment upon maturity. Guys, if you want even more information about this loan, take a look at the video that I did up here. So there were several different reasons why they took this loan, but as they state here, one of them is that the commissioning of the Very Good facility in California. Finally, a little more information about that. We've been missing that as of late. And it's estimated to be around 30 to 50 million Canadian dollars for the purpose of scaling even newer and existing products already in the market with proven demand, right? But also new SKUs, right? It's also a good point that they talk about here that they want access to significant liquidity and financial flexibility. And obviously, when you're expanding quickly, you need to have that capacity, right? And it's also talking about it's not only the e-commerce sales growth strategy in the US, it is about the launch into Europe as well as assist with the company's working capital requirements. So good on that. And as we talked about before as well, they're also doing this because they want to be ready to be able to launch new products, but also maybe potential new mergers and acquisitions opportunities. And we talked about that. Could that be maybe in Europe? Could they be acquiring a new facility maybe there with time? Yeah. Time will tell, right? But this is what the CEO had to say about that. Quote, the closing of this credit facility is a key milestone and a testament of our ability to access favorable financing while diversifying our capital structure, and we are very pleased to have the VRYYF Capital team as a partner as we execute on our growth strategy. This credit facility provides us with funding to establish our operations in the US and will be used in part for the build out of our California facility. We are pleased that VRYYF Capital believes and supports our company's mission, products, and strategy to want to be part of our future success. And as we know, with the company's history, they have had loans before that the interest rates were really, really high. I mean, I think I saw an interest rate around 40 to 50%. And now for a lot of us, 9.95% seems kind of steep as well. but not comparatively to what they have had, which kind of proves that they are proving themselves more and more, even in the world of finance, right? That companies or investments banks are ready to back them up. And as we should know by now, it is supposed to be paid back within 24 months. And it says here June 7, 2023, subject to VRYYF's option to extend the maturity date for an additional 12 months on terms and conditions to be mutually agreed to between the company and the lender. And more information about that, they are giving out 225,000 common shares purchase warrants. We talked about that in the last video too, and what that could potentially mean. And one of the reasons they're doing this is so they are able to not dilute too much of the company's shares, right? My understanding is that it is getting some kind of dilution here, but not as much as that could have been. And I understand on paper, this might not look good for some people, that you have to take a loan for $70 million when you're such a small company as it is right now, with a market cap about 400 million Canadian dollars. But not only that they've had a yearly revenue of 4.6 Canadian million dollars, right? But that's, again, we know, most of us anyways, where this company is headed, what kind of growth potential it has in the years ahead. Not only with the Rupert facility, and the Rupert facility in itself is going to explode, as we know. We can potentially see $100 to $200 million coming out just from that facility alone. But opening up the Patterson facility in Cali is going to be a whole new ball game, as we know. And personally, my experience with growth companies, disruptive growth companies like this, like Beyond Meat, like Tesla, for instance, you have to have capital, right, to be able to expand rapidly. You have to pay more in the beginning to be able to make more. It's like that old saying, to be able to make money, you have to spend money. And this is certainly true with a lot of companies out there. And I think this is the right strategy for them, because what we've seen so far, they are very popular. They're doing really well. They're jumping from 300 stores to about 3,000 stores in the end of the year. So I do believe that money will be well spent. What do you folks believe? Let me know down in the comments. So this takes us to the next news, which is Tattooed Chef. Let's just take a look at the stock chart there, and ticker symbol TTCF, as we're familiar with in the NASDAQ. Right now, after being open around 8 minutes, it's trading down about minus 1%, right? And it is at 22.15%. So not much happening at the moment. And the news we got from today from the Motley Fool, and I must say, I'm really happy about this. And why is that? Because yes, the information here is basically a lot what many of us already know. But what I like about this is that we're beginning to see more and more coverage of the company. And I like that, because the only plant-based company that's basically getting non-stop information at least a couple of times a week, sometimes several times a day, is Beyond Meat. And obviously it is because it is the most famous branded plant-based company out there. But if we see more and more, like we see with the Tattooed Chef, again, I think that's a really good sign. So they talked about here why Tattooed Chef stock jumped 20% in May. And the reason for that, according to this text, is that investors were satisfied by the food specialist latest earnings report. And for some of you, this could be a quick recap, right? But as they stated here, in the first fiscal quarter results in mid-May showed 59% sales spike. And also discussion about that they're moving into other kinds of food, right? Like convenience snacks and meals. But also that they're going to increase the distribution, build the brand awareness even more. And we know that they came out with the new facilities too in New Mexico. So, but also talking about the downside of the profitability decline, that the company's net losses rose to 8 million from 6 million a year ago. And we know a lot of those reasons why that is, because they're on the expansion phase right now, right? So it's not strange at all. And it's also highlighting that this chef is in an aggressive expansion mode here, right? And that they do have a shot of actually expanding sales by as much as 63%. And they believe that most of that will come from the core business, which is obviously true when it comes to right now, but obviously from, as we talked about, the acquisitions of the Foods of New Mexico is going to have part of that. But I do find their expectations here interesting. It says that the annual revenue total is likely to be less than $242 million in 2021. And obviously that's possible. As we know, the company before the acquisition believed that they would have about 222. So this is 20 million more. But I think personally, there's a possibility that we can see higher than 242 because we really don't know how long it takes them to get those New Mexico facilities to start going. But there was some speculation that it would be quite quick, right? So I do believe we could see more than this. But something else that I do find funny here is that they're comparing the company with PepsiCo. So the author is kind of complaining about that the stock is valued more than 7 times that figure. So they're talking about this figure, not what they've been making so far, right? So that would be a PE's ratio about 7, which is, I would say, really good for a disruptive growth company. Really good, guys. But then it equated with PepsiCo, that in context is valued at less than 3 times its annual sales. I took a look, it's 2.86 in PE's ratio. Why would they compare it with PepsiCo? I mean, PepsiCo has existed forever. It's not really a growth company in my eyes. Let me know, folks, what do you feel? Is PepsiCo a growth company? I mean, the only way I see it to be somewhat of a growth or disruptive company to some extent, in a very little way, is that they're going to collaborate with Beyond Meat and create new kinds of snacks and beverages with them. And that department then will be disruptive and seen as a growth company maybe. But overall, right now, what they've been doing, I don't see them as doing anything spectacular that they haven't done for years and years. So why would they compare it with that? I find that very strange, the way they're basically comparing a value company with a growth company. And I don't think they can do that, not in my opinion. But again, in conclusion, like I said before, I think that Motley Fool is starting to cover this company more and more. And I feel that as of late, the last couple of months, we have seen a little more coverage coming on the chef. So again, that's a really good sign of things to come. I do expect that hopefully we can see a couple of times a week getting more and more information about this company, considering how huge it is, because it is kind of weird that the Very Good Food Company, which you guys know, I love that company, but it is on paper, it doesn't look as attractive as the chef, right? Even though I think it is super attractive, but on paper, it doesn't look as attractive. And that company releases statements after statements. But that's the difference, right? They are mostly releasing those statements themselves. When it comes to the chef and Beyond Meat, it's getting more and more often that we have other finance magazines or analysis coming out with their articles stating where they see this company going. And that's what we want to see long term, right? I believe obviously this is soon going to happen. They're a very good food company as well. But for now, it isn't happening because it is quite small, as we know, comparatively to the chef. All right, folks, that was it for today. I truly hope you got some value from today's video. Wasn't anything super new, but I think it's good to be updated anyhow. So if you feel the same way, feel free to smash that like button. And if you want to continue getting more information about these two companies and other PlantStock companies out there, make sure to subscribe and don't forget that magical bell button. Thank you, folks. And do not forget, this was not financial advice. These were just my own thoughts and opinions. It's important to do your own due diligence and invest safe. Have a great Monday. Hope to see you soon, and peace out.